If you want to give a bunch of money to your children, we're going to talk about today is how to give to them in a way that's not going to have any tax implications. For today, this is not a recommendation. This is purely going to be educational and to arm you and educate you and help you and your family enjoy the fruits of your wealth and to see your children enjoy that wealth while you're still young and healthy. So let's go ahead and dive in. First thing I want to cover today is the difference between a gift tax and a death tax. On the federal level, with the OBBB, the One Big Beautiful Bill that was passed here in July of 2025, the death tax, which is also a gift tax limit, was increased to $15 million per person. So if you're a married couple, that's $30 million per person. And what that is, that's a lifetime limit that you can give to your children without owing gift taxes. But if you're going to write a check for $1 million, there's certain things you need to do. The other thing that you need to be aware of is your state gift or death tax. So for Minnesota, for example, they have a death tax limit of $3 million per person, but they do not have a gift tax limit. So I'm going to go through an example of a $400,000 gift, how you can use that, how you can do it right, and put your children in a great spot, and also add in a few things if you needed to have some handcuffs or some guardrails on that large gift. So the first concept to cover is what's called the annual giving exemption limit, which is, as of 2025, $19,000. So if you're a married couple and you have a child, each of you can give $19,000 to your child and not use your lifetime exemption of that $15 million per person. So 19 times 2, that's the total amount that you can give and not have to do anything fancy as far as the disclosure of those gifts. The other thing that you want to be careful though is if you give $19,000 in a check, that also means that you can't give them an additional dollar for their birthday or for pay for their travel. There are some exceptions if you're paying for medical expenses and you pay those directly to the institution, or for education you give it directly to the college or university. There's some exceptions there. But that $19,000 annual giving exemption, if you're under that, you can do that per person. Especially also if your child is married, well then that's $19,000 times 4. Because you give $19,000 to your child, your spouse gives $19,000 to your child, then you give $19,000 to your child's spouse, and then your spouse gives $19,000 to your child's spouse as well. So you can start racking those up over the course of time and annually. So I'm going to cover an example of a $400,000 gift. And I'm just going to use it's just yourself and your child, no spouses involved. So here's what we need to do if we want to give $400,000. One is we give the check, the $400,000, and we're going to reduce that by that $19,000 per year exemption. So you're left with $381,000. That we're going to do is we're going to use our lifetime exemption on the federal level by filing what's called a Form 709. That is a couple pages, and basically what you're going to be doing is you're going to be filling out the form that you're saying that I am using $381,000 of my lifetime exemption and reducing that $15 million by that $381,000. And the reason to do this is, one, you're disclosing to the IRS that you gave this gift and that you're reducing your lifetime exemption. But the second thing you're doing is you're starting the clock. So when you file that gift tax return, you're giving the IRS 3 years to contest that calendar year and the gifts in that calendar year. So if you file that return in 2025, fast forward past 2028, now the IRS, if they haven't audited you by now, they would not be able to go back in time in 20 years from now and audit that specific year and the gifts that you made. So it's more so just to protect yourself and start that clock, as well as keeping a record of how much lifetime exemption you have left. The last thing I want to cover is if you believe this $400,000 would be a detriment to the child's life, but you want to help them out, you can do it in a form of a loan. Now, if you do it in the form of a loan, there's a thing called an AFR rate, or applicable federal rate. You can just Google IRS AFR rates. And what it specifies is the minimum interest rate that you can charge your children before it's starting to impact your gift exemption. So if you just loan $400,000 and have a 0% interest rate, that's not actually real. That's not like a real document So the IRS knows that you're trying to scoot around certain requirements. And so there's a minimum interest rate, depending on whether it's short term, medium term, or long term, a minimum interest rate that you have to charge your children. And it changes every single month. They update those rates every single month. In the month that you create this contract, you have to at least use that minimum interest rate, depending on the term. That, let's say, for example, it's going to be 4%. That $400,000 will be charged, your child will be charged that 4% per year. You will have to pay taxes on it, and your child will have to pay it. But one thing that you could do, even though you are paying taxes on that 4% on the $400,000, you can also forgive that interest as well. Again, you're still going to pay taxes on that kind of that phantom income that you're generating from that loan. But that's a way to get assets into your child's name for them to buy a house or do something big or start a business. But you do have to charge that percentage. And then again, you can always forgive the interest rate as well as the principal on the loan up to that $19,000 a year to try to give them a little bit of more relief. So I hope you found that helpful. And if you did, please go ahead and like, subscribe, and hit that notification button. Thank you.